Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Poniotu, certified financial planning professional, the Cap and Capitalize. And on today's episode, we are going to go over 5 financial planning tips for families. But before we do that, the free tip of the week is: the most boring investments are oftentimes the greatest long-term winners, but in the short run, they will be ignored. So a couple of weeks ago, I was actually revisiting one of my favorite investors who I think I've mentioned him a decent amount on the show, Peter Lynch, and I'm not being facetious. And with Peter Lynch, he ran a fund, the Fidelity Magellan Fund, from 1977 to 1990. Over that 13-year period of time, I think his annualized return was 28 or 29%. I mean, it was just insane. And if you looked at what Peter Lynch invested in at the time, okay, you got to go back to the 80s because a lot of these companies are not around anymore. But it was so almost like stupid how easy it was to find these companies. And that was the beauty behind it. Like, one of his best investments was Toys R Us, which again, now it's dead. But at the time, it was an amazing company. Another company today, WD-40. I think he invested in like waste, I think it was Waste Management or Waste Connections, one of the two. He invested in Wrigley's Chewing Gum, like all of these very black and white, easy to understand businesses. And so the reason why I have to stress that is, and I see this in my practice, people go, well, why did you decide to invest in that company? That's so boring. Generally speaking, when everyone is bored out of their mind with a business and it's overlooked, eventually what's going to happen when people realize that the boring businesses are the cash flow kings, that is when in the long run, you are going to maximize your return on your portfolio. So that's the free tip of the week. And let's get into the 5 financial planning tips for families, which in no particular order. Number 1, we're going to start with is look into life insurance immediately. So obviously this is very valuable because if you have a family and you love them and you die prematurely and you're not, you would be dead, but your family is not ready to actually like live off of the investments that you have not yet been able to accumulate, life insurance is kind of a no-brainer. But I first want to talk about the 2 different types of life insurance. There is term life insurance, which is temporary. And then there is permanent life insurance, which is for like when you die. And, you know, if you're listening in and you're a younger family, which probably most of you are, it's one of those things where I don't want to get too far ahead of this, but permanent insurance could actually become a valuable estate planning tool. So if someone comes into my office and they are just bone dry when it comes to insurance, but they know, I know they need it. What I like to do is use a combination of the 2. So for term insurance, very easy example. Let's say that you have a mortgage and it's $500,000 and you've got some student loans, a couple $100,000, now you're up to $700,000. And then, obviously, you live off of what, $4,000 a month. I'm just making this up. So with term insurance, what I would like to do is say, okay, if someone passed away, the other person in the family, right, that's in the household, would basically be able to keep living the life without having to pay all of those debts, right? You free all of those up. And then on top of that, you'd want to maintain your standard of living. So we've talked about this in previous episodes, the rule called the 4% rule, which when you retire, if you took your portfolio, your net worth that you can invest, and you multiply that by 4%, and you took that out every year, there is a 95% chance your money will outlive you. I actually had the godfather of the 4% rule, Bill Bengen, way back in the show on our podcast. And that was actually a fantastic episode. Love you, Bill. Now, the reason why I bring up like the term side of things as using like just simplistically a combination to pay off the debts and maintain the standard of living, it's pretty black and white. Now, another option that I have seen is just using term insurance to have those debts paid off. So if you just had, $700,000 in mortgage and student loans and all that, you'd want to pay all those off. But then the 4% rule, instead of using term insurance, you could use permanent insurance to purchase that as well. Now, the reason why that can become valuable is, let's say that you live through the term, meaning your mortgage and your student loans in this case are paid off. Therefore, the term policy lapses and you're done. Permanent life insurance can be used as a Swiss Army knife in retirement as well as estate planning. So going back to the chances are, if you're listening in, you're probably a younger family. That's a great thing because generally speaking, the younger you are, the more time you have, the more valuable your net worth will become. So let's say that you are listening to my award-winning advice and you take out your term policy and you take out a permanent life insurance policy on the 4% rule. So let's say it's $1 million or whatever the case is. But the death benefit is growing over time because your cost of living is growing over time. And let's say that you get to retirement and you're not dead. Well, the death benefit is off to the side. There's another column that your money's going into, and it's called the cash value part of your policy. And you could actually take loans on that. And in many cases, it'll be tax-free for a pretty decent amount of time. And that could be used as a tax-free Swiss Army knife in retirement for your income. But then if you really want to go down the rabbit hole and down your life and you go, okay, I've listened to you for many, many years, Chris, and I've grown my net worth to multi-millions. Well, congratulations. Highly doubt you want your kids to fork up a ton of tax that's going to go to the government when you pass away. So I'm just going to use an example today. So even though this is going to change here within 2026, but I digress. If you are worth over $13 million today, and let's just say you're single and you got a couple kids, okay, just to make it really, really easy. You're worth over $13 million. Anything over $13 million will be taxed at 40% going to our great nation. I'm being facetious. So because of that, what if you had a permanent life insurance policy that you could take that death benefit and it would pay for the taxes? Whoa, pretty cool. That actually happens all the time. Here's where it gets a little interesting. Advisors and planners inappropriately sell these strategies, whether it's whole life, universal life, variable, it doesn't matter, permanent life insurance in general. So they sell it to their clients or people that are listening in. They will go and say, hey, I'll get this life insurance policy in my name. The reason why that is wrong is that stays within your estate. I know I'm going a million miles a minute, but you got to keep up because that's what the show is all about. So what you are going to want to do is you're going to want to set up an irrevocable life insurance trust and IL it, and you're going to take your permanent life insurance policy and then simply transfer it into that trust because it's out of your taxable estate. So by the time you die, what happens is that trust pays for the taxes that your estate owes. Therefore, you just made your heirs a boatload of money and it's not going to the government. Fantastic. So that is why you need to look into life insurance immediately. Also, I would probably recommend you listen back to this segment a couple times because I know we went through a ton, but we got a lot more to cover. And frankly, I don't have time to wait, and neither do you. So number 2, okay? And number 2, meaning the financial planning tips for families. I don't have to go number 2. It's a classic second grade joke. If you have young kiddos and are interested in college planning, 529 plans is going to be the way to go. Now, why do we choose a 529 plan as a vehicle predominantly to go and invest for post-graduation? Okay, college, law school, medical, whatever. So there are other college savings accounts out there. I know Coverdell is another one. The bummer with that is the limits that you can put in to these accounts are super low. I think the Coverdell, last time I looked, it was like $2,000. Technically, there is no limit to a 529 plan. However, according to gift tax laws, I'm blanking here, I believe it's $18,000 as of 2024 that you can put in per person, right? So let's say that your mom wanted to contribute to the 529 plan for you, or your kid. Let's say that you wanted to put in $18,000. When you do that, it doesn't go against your gift estate tax limit, which that is beyond the scope of this episode. Also, you can get really creative with that. You can invest that money a little bit more liberally than you can in Coverdell accounts. But then with 529s, you could also use it kind of as an estate planning vehicle. And let me explain that. And before I explain that, what I would tell you in a perfect world, if you have a family, or excuse me, if you have kiddos and you love them and you want to start a 529 plan, in a perfect world, I would not say that you are the one that should be contributing to the 529 plan. And let me explain this. So you got family members, you've got friends that want to contribute to, your lovely little child. And so what I would actually say is every Christmas or every birthday, whatever, you have your friends or family go, hey, instead of buying, frankly, useless gifts, I would contribute to their future and basically pay us cash so we can go into the 529 plan. The reason why I'm saying that in a perfect world, you don't put the money in is you do run the risk of your kid choosing not to go to college, okay? Or trade school or whatever the case may be. And the reason why that's a big deal is when you put money into a 529 plan, that's with after-tax money, the gains are tax deferred. And then if you pay for qualified schooling expenses, which there's a laundry list with them, all that gain is tax-free. So if you had, just to make math really easy, let's say that you put in $50,000 and it grew to $150,000 when your kid goes to school, that's $100,000 of gain. That's a long-term capital gain. So you just avoided, let's call it $20,000 in taxes you wouldn't pay. Fantastic, okay? Other than the government, everyone's happy. Now, one thing that is kind of interesting with the 529 plan on top of this is in 2024, things got a little bit more interesting. So starting in 2024, you are actually able to take up to $35,000 from a 529 plan, and you can convert it into a Roth IRA for your kid if the 529 plan has been open for at least 15 years. That's also kind of an interesting one. And, you don't want to use a 529 plan purely for that. But before this ruling happened, what ended up occurring was people would be saving for the college expenses. And then what happens is their kid goes to college. And then you've got all this extra money. And you're like, well, I can't really do anything else with this. I'm going to be taxed. I'm going to be penalized on that. Not only are you going to be penalized for the capital gain, you get a 10% penalty on top of that. Ouch, not fun. So what I've actually told people, if you don't want to do the Roth side of things and you actually have extra money in a 529 plan, keep it in your kid's name as a beneficiary. And then when your kid has a kid, formerly known as your grandkid, you simply change the beneficiary name to the grandkid. And now, as a cool little, frankly, cost-effective estate planning tool, you just paid for your next generation's schooling. And with a 529 plan, you can also pay for private school K through 12. So even if your kid doesn't want to go to college or trade school or whatever the case may be, but you want to provide a quality education above and beyond public school, and you've got the 529 money to do it, you can do it. Okay. So 529 plan, that's going to be the way to go. Now, the third financial planning tip for families before we head into the commercial break. When in doubt, err on the side of cushion when it comes to emergency funds. So we have talked ad nauseum about emergency funds in the past, but some of you are new to the to the show, so welcome. And I want to make sure that I get your feet wet appropriately. So with capitalizing your savings, you want to have anywhere between 3 to 6 months of expenses set aside in your savings, preferably an online savings account. And that is on top of a floating 1 month of expenses in your checking account. Now, the reason why I'm erring on the side of 6 months with a family, there's a couple. So let's just say you're, single, no kids, no plan to have kids or any of that stuff, and you work in a very low risk job. You could probably get away with 3 months and call it good, because anything above and beyond that, you don't really need that much cash, okay? Cash is one of those things that you only should have exactly what you need. And then by definition, anything above and beyond that, you're actually being imprudent with your money. Now, why do I err toward the 6 months for families? Especially, and this is especially important if you've only got one, financially speaking, provider in the household, okay? Well, let's face it. If the main moneymaker is out of commission for a couple months, that sucks. Like, in many cases, a lot of families can be royally screwed with that. And even if you've got 2 people working, I could make the argument because, and we have a almost 19-month-old at home as of this recording. She's expensive. Like, kids are expensive. They are not cheap. And then plus there's the alpha, right, which is a little value add term on the fact that, like, you just buy unnecessary things for your little one. Like, we just bought, what was it? Like 13 different Burt bibs because, of course, they're on sale. And so my wife said, well, clearly we're saving money. I'm like, no, we're not, but there's no turning back. And also there's certain battles I just know I'm not going to win. So having 6 months, obviously, like, sarcasm aside, it is not only financially, I would say, more prudent, and I'd be okay with it. Emotionally, it's going to pay you dividends in the long run, because I don't want you, I'm speaking for us guys out here, I don't want you sleeping on the couch, okay? It's not fun. Now, one thing before we go into the commercial break, I'm going to level up a little bit. Over time, as you take anything above and beyond what you have in your savings and you invest that, and this is way down the road, but it's good for you to think of this. As your money starts to make you money, you won't necessarily need as much cash per se. And that is, that's especially true if you've got 2 people working in the house. But even if you've got just one financial breadwinner, over time, you won't technically need as much cash. And so even though when in doubt, it pays to be flush with cash, let's just think about this, and then we're going to go into commercial. So let's say you need $5,000 a month to live off of. And from your portfolio, you're making $1,000 a month. Okay, cool. And again, forget like what you're making from your job. You probably still need that 3 to 6 month window. Like that doesn't change. Well, let's say that you're making $2,000 or $3,000. All right, it's getting a little bit easier, because let's say you are out for a while and you're living off your portfolio income. Well, that's going to mean that you might not need 1 extra month. Like you need 1 less extra month, if that makes more sense. But now, what if you get to the point where, you're making $5,000 a month and you're living right off of $5,000 a month. So your portfolio is paying for your day-to-day life. All right. Well, if you've needed 6 months your entire time, I'm not saying don't have any cash. Like that is royally stupid. But what I would say is, instead of 6 months, you really might only need 3, because like, unless something gargantuan happens in a negative way, you're going to be fine. And then what's going to get really interesting is, let's say your portfolio is making 10 grand. Okay. Like literally it's making twice as much of what you actually actively spend on a monthly basis. Man, at that point, you could argue you may only need like 1 to 2 months worth of cash. And then if you really start cranking it up, like some of the wealthiest people out there, then what happens is you look at cash institutionally. Like, hey, my net worth is whatever it is. I need this percentage in cash at all times. And then the emotion is like completely out of it. So that was a fun little bonus on the evolution of cash. But when in doubt, err on the side of cushion when it comes to your emergency fund. So with that, we're going to take a quick commercial break. And then when we come back, we're going to close out with the last 2 financial planning tips for families. Stick around.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayiotou, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
Welcome back to the show. I missed you dearly. We're just going to get right into it because I can't wait. And the 4th financial planning tip of the week is fall in love with Costco. I'm not kidding. But jokes aside, you got to think about this for a second. So when you are a family, generally speaking, you're buying in bulk. And so when you buy in bulk, where do you go? You go to Costco. I mean, more likely than not. If you just need something picked up and it's kind of a one-off deal, you go to your, whatever it is, Walmart, local mini mart, whatever the case. And the reason is when you go to Costco and you buy in bulk, your dollars are going to go farther. So again, jokes aside, think of your company's retirement plan as the Costco to your retirement. Now, can you get as custom in your 401k as you can in an individual retirement account or a Roth or just in an individual investment account? No. But at the end of the day, it doesn't really matter because 90% of the success that you're going to have is actually doing what you need to do from a simplicity standpoint in maxing out the easy wins, which is actually like putting the money in the right accounts. The remaining 10%, I could make the argument, is from the investment side. And do not take my word for it. Actually take Nick Murray. Nick Murray is one of the most renowned financial planning and financial advising authors in our industry. His book, Simple Wealth, Inevitable Wealth, I actually just gave a shout out on LinkedIn and Instagram a couple months ago. So I've been a huge fan of his. He has actually said that, ad nauseum with his book, which just had its 25th edition come out, which is pretty freaking cool. Also, it reminds me that I'm very young in this space because I'm 33, just period. His book is 25 years old, but that's beside the point. So when it comes to retirement, unless you've maxed out your 401k, which is as of 2024, it's $23,000 per year. And if you're over 50, it's $30,500. And that's per person. Okay. Until you've done that, do not look into an individual account, a Roth, an investment account, because one, you get a match. Okay. So most companies have some form of a match. So if it's dollar for dollar up to 4% or 50 cents on the dollar up to 5%, you're going to want to put in at the bare minimum that, because that's free money. But above and beyond that, let's think about this from a fee standpoint, because with Costco, you're buying it wholesale. With retirement plans, you're doing the same thing. There's no front end, there's no back end fees, generally speaking. It is wholesale pricing. So if you want to buy an investment in your retirement plan and it's the same investment outside of your retirement plan, within your retirement plan, it will be cheaper. And then also just the simplicity side of things. And I've talked about this a lot. We have, our average client's net worth in my practice is about $3 million. And we have had clients that have come in and they've got their 401k, which becomes an IRA. And in some, actually more often than not, that alone could be worth a couple $1 million. And they never got close to maxing out at that 23 or 30,500. Okay. Never got close to that. So I tell you this because one, those are the limits and it's good to kind of know what the limits are. But two, even if you never reach that, that is okay. One of our most successful clients, he actually just passed away. So, but he said to me, I miss the days when financially life was more simple. Be simple. Keep it simple. Okay. Now, the last, and I would say most important financial planning tip for families, just get started. Now, far too often, people, and it's not just in my industry, like it's just finance in general, they sweat so many small things. Like go back to what I said with Nick Murray. 10% of your long-term investment success will be maybe from the investment selection. The 90% is just doing the damn thing. And I could go down a list of that. Oh, you got high interest debts, pay them off. Like no questions asked about that. Oh, life insurance. You want to make sure that your kids and your spouse are taken care of. Yeah, you should probably do that. Oh, estate planning attorney. You should probably talk to one. Oh, your taxes. Maybe get a second opinion. Pay a couple $100 to make sure that your taxes are in order from a CPA instead of going online. And even though it's free, there's a cost to paying for something that is free, if that makes sense. Don't sweat the small things. Eventually, over time, you will get comfortable. And it's not like I'm asking you to go on to Fear Factor and eat a bunch of spiders and, swim with snakes in the mud and all that. Like, I am asking the bare minimum to just get things going, which also brings me to the point where the more you procrastinate of getting all of this done, that is not only financially, but just emotionally, it's going to destroy you. Like absolutely destroy you. And it wasn't until like later in my career where I discovered the whole idea of the three concepts of people, those that fight, those that fly away, and those that freeze. I'm thankful that I'm a big time fighter. Like if I see something that is in front of me that I need to get done, I just rip the head off of it and go for it. I just plow through it. Some people don't have that. And that's okay. But regardless, even if you are, like, oh, I'm just going to look away and I'm not going to do this, or I just freeze up, just take a deep breath and start, get it going. Okay. Now, for you all, that's really all I had today as far as like the 5 financial planning tips for families. I could have made a litany of other options, but I would say these are the top 5 that are going to get you the best bang for your buck. So if you want me to do a continuation of this episode, let me know, whether it's on social media, email, whatever the case may be. But regardless, I look forward to seeing you all back next week. And as always, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher A. Poniotu, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without without notice. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with your investment objectives. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Earnings from a 529 college savings plan can grow tax-deferred and may be withdrawn free of federal taxes when used for qualified educational purposes. Non-qualified withdrawals are subject to a 10% penalty tax. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Coverdell accounts can affect financial aid significantly or not at all. It depends on who is designated as the owner of the account. Withdrawals from Coverdell accounts are generally tax-free to the extent that the amount of the withdrawal is not more than the beneficiary's qualified education expenses. LPL Financial Insurance License Number 0518721. LPLIA Insurance License Number 0B91442. Christopher Paniotu is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Capitalize Your Finances, a separate entity from LPL Financial. The people and companies mentioned in this podcast are not affiliated with or endorsed by LPL Financial or Capitalize Your Finances.